if gold were to go to 8,000 and sort of do a normal, oh, it did another eightfold, okay? And silver were to go to 2% of that, okay? Now, what if gold were to do something more dramatic?
Yeah.
Silver could easily be in a couple $100. I'm not going to put a number on it because when you're dealing with parabolic moves, and I think we're entering a parabolic phase, or what chaos theorists would proudly say, this is chaos. We're no longer incremental. We're now entering that by our metrics, and we can see the reasons why. We've been discussing that. Silver could go berserk.
Gold and silver prices are rising, with silver significantly jumping in early U.S. trading on Tuesday. Positive market conditions are supporting this upward trend. June gold futures are up by $14.30, reaching $2,348.80. And July silver futures have climbed $1.296, hitting $31.795. This year, spot silver prices have surged 35%, reaching 12-year highs, and now stand at around $32 an ounce. In contrast, spot gold prices are approximately $2,350 an ounce, with a 14% gain this year. Over the last month, silver has outperformed gold, with the silver-gold spread reaching levels last seen in mid-November 2021. A breakout above the mid-October 2021 high could widen this spread further. Renowned analyst Michael Oliver highlights gold's historical performance during past bull markets. For example, between September 1978 and January 1980, gold prices nearly quadrupled from $217 to $850 per ounce. Although a period of profit-taking reduced the price to around $500 per ounce by the end of March, gold soon resumed its upward trajectory, reaching $600 by early June and approximately $680 by mid-September. Similarly, from 2001 to 2011, the price of gold increased eightfold. Given the current economic situation, Michael anticipates that gold could rise much higher. Conversely, silver tends to outpace gold in terms of percentage gains during bull markets. Over the last 50 years, there have been numerous instances where the price of silver has exceeded 2% of the price of gold. For example, Oliver predicts that if gold rose to $8,000 per ounce and silver maintained 2% of gold's value, silver would be priced at $160 per ounce. However, Michael suggests that silver could easily surpass this percentage and reach prices of several $100s per ounce, given the current economic uncertainties and potential for extreme market conditions. We will present clips from Michael Oliver's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Go back and look at the prior bull markets in gold, let's say in the mid-1970s up through 1980. Yeah, there was a major correction in 1976 in gold. But basically, you went from the mid-$30 level to the $850 level. Huge percent gain over a span of 10 years. Then look at the 2001 to 2011. It was an eightfold move, okay? So you can say, well, let's say eightfold is sort of not abnormal, okay? Well, we started from 1,050, multiplied times 8, okay? That's to simply replicate what happened in the 1980 peak in gold. And that wasn't anywhere near the fundamental or macro situation we have now. So let's just throw that out there as a norm. Okay, there's another norm to look at. The silver versus gold situation. We measure it slightly different. Most people look at ratio. We do a percent thing. What we do is we divide an ounce of silver into gold. And right now, silver is about 1.3 something percent the price of gold. If you go back over the last 50 years, create a bar graph, which we've done and put in our reports. There was one time back in the 1970s, mid-70s, I think it was, silver got up to 6.5% price of gold. Okay, let's eliminate that as an erroneous alone situation. But there have been over 20 times in 50 years where at some point during each of those 20 years, silver got up to over 2% of the price of gold. Okay, and sometimes 3%. Okay, but let's just say 2. Well, if gold were to go to 8,000 and sort of do a normal, oh, it did another eightfold, okay? And silver were to go to 2% of that. What if gold were to do something more dramatic?
Yeah.
Silver could easily be in a couple $100. I'm not going to put a number on it. because when you're dealing with parabolic moves, and I think we're entering a parabolic phase, or what chaos theorists would probably say, this is chaos. We're no longer incremental. Okay. We're now entering that by our metrics. And we can see the reasons why. We've been discussing that. Silver could go berserk. Think about it this way also. You look in late that 1979, for example, to 1980 move. I think silver went from, look at the 2010, it was in late 2010, silver started to accelerate. It's been going up with gold all during the years since the 2001 lows, but in an arm wrestling manner with a lot of plateau regions like we just went through the last 3 years in silver and gold. Plateauing bored the heck out of you. You didn't want to be there. You're sick and tired of it. Okay. So a lot of people vacated, but when it went into that acceleration phase late in the bull trend, in 2010, silver went from 20 to 50 in a matter of about 7-8 months.
Yeah.
So, and that wasn't even in the type of fundamental or macro situation we're in now, which could create something far, far more dramatic in terms of price levels.
The bond market is flashing new warning signals, hinting that inflation pressures might persist well into the upcoming summer. Typically, U.S. Treasury bonds, T-bonds, perform solidly during bear markets, with yields dropping. However, since late 2022, T-bonds have been struggling, with yields climbing, indicating a weaker market than municipal bonds and high-yield corporate debt. This decline is problematic for the Federal Reserve, signaling potential liquidity issues and even panic, a concern echoed by Treasury Secretary Janet Yellen. The Fed faces pressure to respond to weak economic indicators, such as job market vulnerabilities, which could prompt additional liquidity injections, including increased bond purchases to stabilize the T-bond market. A significant stock market downturn, even a modest 5 to 10% drop, could accelerate such actions. Given these market dynamics, investing in gold and silver appears prudent, particularly through miners and physical bullion. Michael Oliver suggests miners could yield significant gains, potentially outperforming other investment categories. Amidst the uncertainty and warning signals from the bond and real estate markets, precious metals emerge as a favored strategy for investors seeking stability and potential returns. Let's get back to the interview.
The T-bond market wasn't getting kicked in the gut like so many other private bonds were. Like, the collapse of Lehman Brothers and private debt is in jeopardy. But if you'll look at the T-bond price action downside since late 2022 and compare it, for example, even to municipal bonds or to high-yield corporate debt, it's weaker. Meaning, why is the T-bond market under such pressure compared to other debt markets this time? That's got to be of maximum concern to the central bank. Because when their instrument, their long-term debt instrument particularly, which they don't control as much as they do the short end, is in panic mode. And even Secretary Yellen has used the word, illiquidity in the bond market concerns her. And she meant the T-bond market. That is something they don't like to talk about, because if they did, it would indicate panic. But they cannot have that debt instrument behaving like a crash market like it did last October, for example, or October of 2022. So that's got them troubled, ongoing, okay? And that market remains capped and under pressure. I think it could change, but right now that's the case. So that's a constant nervousness for the Fed.
Yeah.
And as soon as you start to get some bad data points, and I think they could come quickly, and already we started to see some, bad in the sense that they're less inflationary, because their inflation metrics aren't based on commodity action, by the way. It's too little emphasis on commodities, and commodities are resurging now. But when they start to get data points that indicate economic weakness, job market weakness, they will immediately rush back, because that allows them to help defend the T-bond market.
Yeah.
Putting liquidity and buying bonds, et cetera. So they're looking for an excuse. And I think that's why you got to watch the stock market, because I would suggest that if it even drops 5 or 10%, you're going to start to get the data points that the Fed will then say, aha, we have a reason to not only cease, but drop. I suggest the miners are probably the greatest percent gainers over the next, by the way, I think this is going to be an accelerated process. I don't think we're talking the next 3 or 4 years. I think we're
Uh-huh.
talking mostly this year and into early next. I think you'll have the type of price action that you had in silver and gold back in 1979. Look at a chart sometime, go back to the early 70s through 1980, and look what happened in the last year. Also, go back and look at the 2001 through the 2011 bull market in gold and silver, and look what happened in the last year. I think we've already been going up from a low in 2015. So 9, 10 years ago, okay, gold, 1,050. I think we're in the acceleration phase at the end of that market. The only difference this time is the external factors are far more serious in terms of generating central bank panic than at any time before. And therefore, when they panic, gold is going to be the prime beneficiary. I mean, if you're a portfolio manager and you look around and say, okay, what's doing well? It's a hard pick. And we've already had some major managers like Stanley Druckenmiller back in mid-February, dumped some big tech stocks and moved into Newmont Mining and Barrick Gold.
Yeah.
Newmont's up about 30% since then. So, and a lot of other asset managers have also made that analysis and moved money out of the stock market into that category. I think if you're a non-levered investor, and there's difference now. We're talking, there's some people with leverage and have time sensitivity they could cope with, like options, for example. I'm heavily in call options, especially on silver related, and on miners. Again, call options, but also own outright miners. But if you're non-leveraged and can't take the volatility and the time sensitivity risk, then I suggest just being long miners and outright silver bullion equivalent ETFs. There's several of them around. I happen to choose Sprott.
Sprott is a strong one.
Yeah. So, but anyway, so it's up to the investor as to which medium. But silver and the miners, I think, are the place to be. And I think it will handily beat any other category out there and will, to some extent, reflect the opposite of what's going on in a lot of those other markets.
Silver is expected to continue its bullish trend, aiming to break above the $32.50 level, despite occasional fluctuations. With its inherent volatility, caution is advised when position sizing. A breakthrough past $32.65 could propel silver toward $33, presenting potential buying opportunities during pullbacks. Additionally, silver is anticipated to outperform gold in the coming period, offering investors a promising alternative for investment growth. Will silver's bullish momentum persist, potentially outperforming gold shortly? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.